CNBC-TV18.
Stocks slide across the globe on high interest rate worries as Silicon Valley lender SVB Financial reports losses on its bond portfolio. Asian markets fall 12.5%. Upcoming US non-farm payrolls reports adds to the nervousness. The Wall Street bulls suffer a bruising blow courtesy the global sell-off. The market, however, sees some buying at lower levels with the Nifty still down 1%. Financials and IT stocks see the biggest cuts. Nifty bank trades lower 1.6%. And Tata Motors bucks the weakness as the company's IT services arm Tata Technologies files a DRHP with SEBI. Tata Tech will be the first IPO from the Tata house in the last 2 decades. And Equitas Small Finance Bank shares fall as its reverse merger with Equitas Holdings gets completed and shareholders are allotted Equitas SFB shares for trading starting today. Hello and welcome to Halftime Report. I'm Sonia Shenoy. The market has still not recovered from the lows of trade. So after the early morning gap down, there's no recovery in sight just yet. That just goes to show that this market is very, very cautious at the moment. A little bit of intraday recovery is what you're seeing, but nothing convincing or conclusive at the moment. What the Nifty has done is slipped below the 200-day moving average, which is 17,427. So a crucial level on the downside has been broken. The Bank Nifty is the one where you're seeing intense pressure right now. In fact, the Bank Nifty is approaching its 200 DMA of 39,500. So in that context, it is quite a weak session. Now, this week, a lot of financial stocks are big losers, whether it's ICICI Bank, Kotak Mahindra Bank, Bajaj Finance, all under pressure this week, down anywhere between 2 to 4%. And then you have the jobs data that we'll be looking forward to later in the day. So there is definitely caution on board. Rajesh Kothari, who's the MD at AlfAccurate Advisors, joins us now to talk more about that. Rajesh, hi, good afternoon. What do you do in a market like this? You know, it's pretty much going nowhere. The headwinds are increasing, especially from the global arena. How are you positioned now?
Well, I think, at times to remain disconnected from the global macro noise, I think that adds huge alpha to the portfolio, to be very frank, because the narratives keep changing quickly. Just about 2 weeks back, everybody thought that, we are probably now going to be quantitative tightening is going to stop. And in last 7 days, again, the narrative has changed. So who knows the narrative after 7 days? And of course, you cannot change your portfolio strategy based on everyday's view. So I think, having said that, if you look at yesterday's episode in US market, particularly with reference to that financial corporation, that again tells you that, the difference between Indian economy, the Indian banking system versus the US economy and US banking system. And that's a probably good difference between the two. And therefore, beyond the point, I don't think one should read too much about the US economy. Yes, undoubtedly, markets are linked to some extent. And RBI also might have to act forcefully, as the Fed may do a little bit further rate hikes. And to that extent, there can be short-term volatility. But I don't think one should rate too much beyond that point.
Okay, what do you do with individual stocks, Rajesh? Because I know you track many of these stocks very closely. So I'm going to start with them one by one. Tata Motors is in focus today. I think we're seeing an IPO from the Tata Group after, 19 years, right, with Tata Technologies. The stock Tata Motors has not given great returns to shareholders, but yes, this monetization is definitely a positive. But at this price, how does the risk reward look?
Currently, we do not own this name, so I would not like to comment on this specific name. Having said that, I think the CV cycle, the commercial vehicle cycle, remains strong. If you look at the last 6 months, they've been extremely good, and that is, of course, good for the Tata Motor as well. And if you look at from the global front side, I think as the shortage of semiconductor is reducing, probably if I look at the global car players, particularly all listed global players globally, I think they have done reasonably well because the demand is still very good from the global perspective. So probably that can work in favor of Tata Motor. But beyond that, I don't have any specific comments. We do not own this name in our portfolio.
Okay, so, tell us, how do you approach this stock-wise, right, this entire market? I mean, this is, of course, since the market is range-bound, as they say, it's the best time to be hunting for value, to be looking for good quality names. If you had to create a sort of a shopping basket for us of 4 or 5 names from the large caps and the mid caps, what would they look like?
Well, basically, the one sector on which we are positive is, the banking and finance. And in banking and finance, we own, primarily the top five players. That's what we own. I think the positive surprise in banking and finance is going to be the net interest margin. I think entire street thought about one month back that net interest margins will come again back to normal. But I think because of this interest rate hike cycle, which may continue for one more quarter, even the growth in FY24 can be a positive surprise for the street. So the net interest income growth backed by reasonably good net interest margins, these two things are going to be positive surprise for the street. Asset quality, anyway, everybody knows it has improved a lot, and I don't see any major challenge from the asset quality perspective. And therefore, I think banking sector will continue to get tailwinds from here on, even for another probably at least next 6 months to 9 months. On top of it, of course, the capex cycle is improving. And if you look at the non-food credit growth, while we do get a lot of data on US and markets are down, but look at the Indian data. Look at the non-food credit growth. I think it is sixth consecutive month of double-digit non-food credit growth. It means the loan book is going to remain very, very strong. So on one side, your loan book are going to be strong. On the other side, the net interest margins are not going to contract in the short term. And therefore, the net interest income growth will also remain very strong, double-digit. On top of it, the provisions are going to be lesser. Credit cost is under control. So net, I think the banking stock should do well even from here on. So that's the one thing which we are positive.
Okay.
Second theme, which I've been talking on your channel almost, I think, from last 7 quarters, is the capex play. And whether you look at the new growth drivers, be it data centers, be it smart grid, be it the product portfolio companies, I think most of these companies are doing extremely well. The third quarter results is again showing these trends. Most of these companies have reported 15 to 20% order inflow growth, which is probably historic high in last 13 years. I repeat, it has been historic high in last 13 years. So that is the one space which we like. We like the companies which have a product portfolio backed by the technologies, backed by the parentage of the multinationals with a strong R&D. And I think this kind of companies are going to do extremely well. So we continue to own, names like ABB is one of our large holding, in our portfolios and companies like that.
Okay,
so
got that. Got that, Rajesh. So we've got a fair amount of, an idea about how you're playing the capex cycle. By the way, today in the market, there's a very clear defensive bias, and I'm looking at a lot of stocks on the healthcare and the FMCG side. They're moving higher. Should just pull up some of these names: Britannia, ITC. That's where you're seeing some semblance of, green come through. Rajesh, if the market continues to be a little challenging, then would you look at either of these sectors, either healthcare or FMCG, which have been traditional defensives?
Yeah, so that was the third sector I was coming to. That consumer is a third sector which one should look at it. And in this consumer, you need to look at both discretionary side as well as the defensive side of it. But you need to be very selective in this space. The raw material costs are now going to be under, is going to be good for these companies. So gross margins will improve. We have seen the worst of raw material inflation in last 3 quarters, which will positively benefit most of these, FMCG companies. But on discretionary side also, we like companies which are into wire and cables. We like companies which are into retail side. And those are the bets what we are taking from the portfolio perspective.
Okay, Rajesh, thanks a lot for joining in. Very helpful, actually, how to approach the markets. And you're saying you like the banking space, so perhaps that's the space to look at after all the fall that we've seen in the last many weeks and months. Thanks for joining in. The market has not recovered at all. It's still at that 17,400 mark. So let's do one thing. Let's take a quick break. Here's a programming note, though. On the 14th of March, CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge the gender inequality that exists in India currently and across the world. The event starts at 4:30 p.m. on the 14th of March, and you can catch all the live action right here on CNBC TV 18. Welcome back. Equitas Small Finance Bank is one stock that's under pressure today as more shares hit the market after the reverse merger with Equitas Holdings. Abhishek is here to explain the details to us. Abhishek, tell us exactly what's happened today.
So, well, the Equitas promoter company, that is Equitas Holding, have their shareholders getting the shares of Equitas Small Finance Bank today, which is available for trading as well. So, you are seeing a selling pressure henceforth on the bank. And they have already witnessed a 40% rise in Equitas Holding post the merger announcement till date right now. So, it makes a good sense for them to exit, their holdings. Investec has written an interesting note. They say that, a correction will provide good opportunity for investors who want to invest in Equitas Small Finance Bank, given the fact that bank is in a strong position to deliver a 25% plus CAGR on loan growth as well as 2% plus return on asset over the next 3 years. Asset quality and credit cost are one of the best and is likely to surprise on a positive note. The valuations on a price to book value multiple of 1.4 1 year forward looks reasonable to them, and management certainty is also high. They said that Equitas Small Finance Bank will be a $1 billion market cap bank with 100% free float. So historically, they have seen that, it's an inflection point when lenders do hit $1 billion market cap. Case in point being City Union Bank and Sundaram Finance Bank. So they see investors' interest as and when the bank hits a $1 billion market cap. Back to you.
Okay, thanks a lot for that, Abhishek. Well, the other stock that we're looking at this morning, and in fact, we've been tracking for the last many days, is Electra Green Tech. Now, the good news refuses to end on Electra Green Tech. The latest is that the Maharashtra government has proposed a purchase of electric buses and also conversion of 5,000 diesel buses into LNG run vehicles. Now, this is only a proposal at the moment. It's not a confirmed order, and the order could go to anyone. There could be Electra Green Tech in the front, for this order, or even JBM Auto. But just the possibility of getting more orders is something that has got the street very excited. Now, the additional positive for Electra Green Tech is that the management is the lowest bidder for a tender by CESL for 13,000 electric three-wheelers. And, the LOI is yet to be signed for this, the company tells me. But nevertheless, this is a positive for the company. They're also doing a QIP of 800 crores in the next couple of months, out of which 400 crores will be a preferential issue to the promoters. Now, this is in order to raise funds for a new plant that they're putting up in Hyderabad. There's so much demand that they are going through with a greenfield expansion. They've already acquired 150 acres of land in Hyderabad. This is touted to be one of the biggest electric manufacturing facilities in India. It will initially start with 5,000 e-buses, and then they will progress to manufacturing 10,000 electric buses at that particular plant. So that's another stock that you need to look at. It's up almost 40% in 2023. But with temperatures rising higher than usual across the country, power generation in the months of Jan and Feb has seen a big jump. Earlier today, we caught up with Rajiv Kumar Vishnoi, who's the chairman and managing director at NHPC. Listen into what he had to say.
Demand has been consistently rising for last almost 17, 18 months, demand of power. And we see in some of the months, it has been rising at the rate of 10% also. Now, at the same time, we have been adding capacities also. The country has been adding capacity, and this is the reason we could fulfill all of this demand last year also. There was a great surge in demand, and we could satisfactorily fulfill this demand. Subansiri is in the last stage of now getting completed this project, and 2 units of this project will be commissioning, adding to the grid by the end of June this year. That will be towards the end of first quarter of FY24. Every 3 months, we'll be adding 2 more units every 3 months. So we'll be completing the full capacity in next 1 year or 14 months time. Regarding the Parvati, the first 2 units will be commissioned in the last quarter of FY24.
All right, so that was a word coming in from NHPC earlier. Let's now move to an exclusive, and this is an important story. Sources tell Money Control that SEBI has proposed that mutual funds own their broking, or basically foot their own broking expenses. Santosh Nair, who broke that story, is with us in the studios now. Santosh, great to have you here. So what does this really mean when SEBI is telling mutual funds to literally own the broking?
So what it means here is that mutual funds charge what is known as the total expense ratio. But at the same time, whatever costs they incur on the buying and selling of shares, this sits outside the total expense ratio. Now, as you're aware, SEBI has been trying to bring down the total expense ratio of mutual funds. That's the what they charge their unit holders. So what SEBI is telling mutual funds is that you bring down this cost further. That can be done by bringing those extra broking charges inside the overall TER. Now, so one of the options it has given to mutual funds is that you can get membership on the stock exchange and have your own broking terminal, so that you would not be going through brokers and you would be doing the trades, buy and sell trades yourself.
Okay, so this is a great move for investors, right? It will bring down their costs, I'm sure, Santosh.
Yeah.
But correct me if I'm wrong there. But what about the timeline? I mean, I understand that this entire matter is still in discussion stage, so it's not final just yet.
No.
Any kind of timelines that you're looking at?
The timeline, it's hard to say at this point in time, but clearly this will be a little painful for both the broking industry as well as the mutual fund industry, because for the mutual fund industry, clearly it means you'll have to again rework the logistics of that. And for the broking industry, clearly this is, if at all it does come, it becomes a kind of a rule, or many mutual funds do go for it, then it could mean a hit on the revenues that they otherwise get from mutual funds, because right now on a monthly, every month on an average, close to mutual funds buy and sell about 2 lakh crore worth of shares. And if you were to take about 12 basis points, which is the brokerage that they pay on that, it works out to roughly around 225 odd crores.
Okay, all right. So this is going to be a very important one to watch. Thanks very much for bringing us the details on this, Santosh. Let's see. SEBI batting for retail investors as usual in this case, looking out for more regulations for mutual funds. Well, with that, we will quickly move on and take a break. On the other side, technical analyst Prakash Gaba will join in. We'll talk about a couple of trading strategies.
Welcome back to Halftime Report. It is a tough day if you're a bull today. There has been no recovery up until now. Prakash Gaba is joining in. He's a technical analyst and he's been, of course, watching the markets for so many years. Prakash, what about today? It's a tough one, right? Because we thought that this market was attempting to recover, but that recovery has failed. Any thoughts on how to approach it from here on? Do you think that it could get worse before it gets better? And any stocks that you're looking at?
Yes, good afternoon to you. Looks like it should get worse before it gets better, because it tried to recover, but it didn't even go up there. The recovery is mild recovery. That's not recovery. That's perhaps some kind of short covering, some opportunistic short covering. There's a very good chance in the evening, perhaps later part of the trading session, people who were short yesterday could cover. So at least they'll take the money home. Will it bounce back? That we do not know. Now, if it does not bounce back, the recovery is feeble and not very strong, then perhaps next week is bad. My concern is next week, not today. So it is weak. Recovery is very mild, and I don't see much strength unless the recovery is full strong. That happens only a later part. So meantime, I would like to short it. Canara Bank is a short. Looks like it's weak. It's trading at around 297 or so. And I would have a stop about 300, 3 rupees, not much. Possibly we'll see move down slide to around 290 soon. So Canara Bank is weak. The way it's trading, that is falling like a stone. The move from 270 to 315 was a reactive move, which meant I'm going up to come down. Canara Bank short. Second is State Bank of India. Again, is falling with a gap down, and possibly we'll see lower levels down. Trading at 547.35 now at this point of time. Very good chance we could see levels closer to 540. Stop above 552. State Bank of India still looks weak.
Okay, all right, Prakash, got that. Thanks very much for the technical advice over there. Let's also get in a fundamental viewpoint on this market, which has been grappling with a lot of global issues today. This is opinion that's coming in from Nilesh Shah of Kotak Mahindra AMC. He is of the opinion that the market will start getting extremely attractive if the Nifty falls to a level that corresponds with 15 times forward earnings. Take a look.
From our point of view, we have been saying for some time that this is a market where India is trading at historical average valuation, but we are at a significant premium to all other markets. This will push some FPIs to book profit in India and move to cheaper markets like China, Taiwan, Korea, South Africa. We are looking at a range-bound market from here till probably all the way up to May 24. Global as well as local event will continue to pull market in both directions. US Fed pivot is critical from a global point of view. Russia-Ukraine headlines might have shifted to page 3 and 4, but it is still simmering. Energy prices, we always have to keep an eye on. In local market, corporate results for September and December 22 were relatively subdued. Consumption remains subdued, and there is general election in 24. So there are enough events which will keep market moving on both the direction. If market goes somewhere around below 15 times 1 year forward earning, that's roughly about 1,000 rupee, 1,000 to 1,050 earning per share for FY25. If market goes 15 times below that, then it's a great time to buy. 1,050 already has been revised downwards. And while there has been some subduedness in the corporate earnings, the commentary has not been that bad. September as well as December 22 quarterly results have been impacted significantly by inventory correction.
Okay, that's the word coming in from Nilesh Shah. He says, despite everything, you should still go ahead and buy into corrections. For the longer term investor, that's always a good thing to do. But in the near term, there's some caution, definitely. Let's slip into a quick break. On the other side, we'll get you an exclusive conversation with Chirag Patel, who's the president and co-CEO of Amneal Pharmaceuticals, with Ekta Batra, and our special segment, Medicine Box. Stay tuned.
Welcome back. Well, the markets are looking at pressure all over again. In fact, we are again down over 200 points on the Nifty, and the Bank Nifty is seeing a renewed bout of selling pressure. Let's just pull up the Bank Nifty once again. So there's been an attempt at a pullback, but it's getting sold into, and that's showing up on a lot of different stocks. Pull up Axis Bank, for instance. Of course, HDFC Bank has been quite weak from the start. IndusInd Bank is the other one. That's once again heading back towards the lows of the session. So these are some of the names where the pressure is pretty severe. ICICI Bank. So there's no attempt at a recovery. And if there is one, then it's getting sold into. That seems to be the problem. Those are the big names that are taking the market down. Again, we're looking at a drop of about 208 points. Nifty not quite at the lowest levels of the day, but the pressure is relentless. You can safely say that. By the way, the advanced decline ratio is also pretty severe in favor of the declines. We've got just about 1,000 stocks advancing, over 1,800 stocks on the declining side. So those lines continue to be fairly far apart. Well, let's move on then. Amneal Pharma, founded by two Indian origin brothers, Chirag and Chintu, in 2002, with over $2 billion in sales, is the third largest affordable medicine player in the US market currently. The company, which gets majority of its business from the US, says that the price pressure is in double digits and is not sustainable. The company is looking to make India its second home market. Listen in to Chirag Patel in conversation with Ekta Batra on the Medicine Box.
It is a low double digit actually, so 10 to 12%, and it is not sustainable. We have to keep investing in manufacturing infrastructure, quality infrastructure. So there is no way this 10 to 12% price erosion is sustainable. And the sad part is the savings are not going to the patient. I believe we are the only company that grows even 2% in the generics market in the United States. And we see ourselves growing much faster pace because of the specialty products, biosimilars, and injectables, and the global entry for Amneal coming as we have entered the global market.
Okay, so I assume that you're looking to diversify out of the US into markets such as India to basically capture that growth and probably mitigate some of the US price pressure that you're facing. When it comes to India, what is your plan in terms of scaling up? Are you probably looking at acquisitions?
Definitely, we would be. So let me start with how we have entered it. So India is a big market. We believe India will be growing substantially beyond imaginations in all aspects, as India's economy is doing so well and will continue to do so well, and we're very happy about it. The market, the awareness, the insurance coverage for patients, the awareness for patients, providers is increasing, and that will drive tremendous growth in India in upcoming years. Rare diseases, which are almost impacting 9% of the population, which would be around 100 million people. It needs affordable innovation. There are treatment options available in the Western world, but they're very expensive.
Sure.
So to bring those treatment, we would need to partner with the private sector as well as public sector. So India is an exciting opportunity for us.
Okay, India has an exciting opportunity. We'll leave it at that. Let's slip into a quick break. On the other side, we'll get you more on the markets and stock-specific action. Keep it with CNBC TV18. Welcome back to Halftime Report on CNBC TV18, where let's shift gears away from equities for a bit. It's not moving too much over there. It's still under pressure. And let's talk about the commodity space. Manisha Gupta joins in. Today, the focus is on crude oil, which continues to correct. And of course, there's a big event upon us, which is the FOMC meeting at the end of March. So, Manisha, take it away. Is there more pressure?
It hasn't been a strong start to the month of March when it comes to the crude oil prices. We're trading at a two-week lows right now. And for this week itself, it's down by nearly 6%. Actually, it was in this week last year for March when we saw crude oil prices hitting that $130 per barrel mark. From those kind of levels to around 80, 81 right now is almost 38 to 40% of a decline that we've seen on an year-on-year basis come in for the crude oil prices. It has been about hawkish U.S. Fed, the U.S. dollar index trading on a firmer note, expectations of a more aggressive rate hike going forward from here. And add to that the fact that the Chinese imports of crude oil in the month of Feb were down 10% on an year-on-year basis. So while we have seen China recovery come in, but it is fragile and uneven at the best, and that continues to weigh onto the markets. What markets are watching out for is Total Energies, which is unable to make deliveries from its French refineries. Any development of that, if the supplies do not go through, then there could be some support for prices. But an even bigger data event clearly is the U.S. non-farm payroll data. Those numbers come in the evening today, and that would really set direction for the further crude price movement.
And thanks very much for that, Manisha. Well, let's move on now. Earlier in the day, we caught up with Dan Feynman, co-head of Equity Strategy Asia Pacific at Credit Suisse, to understand his outlook on emerging markets as well as the dollar. Take a look.
We're cautious, and actually we've been concerned about the rally we had earlier in the year. We viewed it as a bear market rally. For us, rates are still an important issue, and we think the worst lies ahead of us for developed market economies. Emerging markets will do better than the U.S. The valuations are looking better. We don't have the inflation problem that you had in the U.S. There's no escape from the impact of higher rates in the markets where you've had big increases. I think in Asia, we don't need to worry about this as much. The rate increases haven't been as steep. Short term, I think that the dollar could be a bit firmer. This is because of the Fed becoming more activist again. But longer term, and I'm talking about, say, 3 years and beyond, longer term, the dollar looks problematic. Our belief that the dollar is going to be weak is a multi-year view. Short term, we're probably going to be seeing a bit of a bear market rally for the dollar. It should be positive for commodities, particularly. I would be particularly focusing on forward-facing commodities that would be benefiting from, say, the carbon transition.
Okay, let's slip into a quick break on that side. But on the other side of the break, we'll put focus on Tata Motors. Its subsidiary Tata Technologies has filed its DRHP with SEBI for an IPO. This is the first Tata Group IPO in the last 19 years. More on that coming up in a bit.
Welcome back. Still around the 17,400 mark. The real fight is for the Nifty. to see if it can hold this 200 DMA or not. The low of the day is 17,324. So we've come a long way from that. But banks are still under a lot of pressure. The bank Nifty is still nursing losses of about 750, 800 points. And that's the big problem for the market. If I just talk about the major movers and shakers, I mean, apart from the banks, which are obviously taking things lower today, there's also Reliance. Second day running, plenty of pressure on that one stock, down about 1.5% as we speak. And then you have the entire IT leg, which is definitely not working in the bulls' favor. So whether it's a stock like Infosys or something like HCL Tech, lots of names on the downside on the screen, even now so far into the afternoon. But let's now move ahead. After almost 2 decades, a Tata Group firm, Tata Technologies, will be hitting the street with an IPO. This is a subsidiary of Tata Motors. Sonia is here telling us more about the company. Sonia.
Well, it's a big day for the Tata Group. Tata Motors' wholly owned subsidiary, Tata Technologies, has filed a DRHP with the SEBI for an IPO. Now, this will be the first IPO from the Tata Group stable after 19 years. The last one, if you remember, was TCS way back in 2004. It also assumes importance as this is the first IPO from the Tata Group under the tenure of N. Chandra, who took over in 2017. Now, Tata Technologies plans on selling up to 9.5 crore shares, which is about a little under 24% of its paid-up share capital. And let's talk a little bit about Tata Technologies itself. It is the IT services arm of Tata Motors, catering to JLR and Tata Motors products. Now, the company provides a range of services, including IT consultancy, SAP implementation and maintenance, and design consultancy, and has an excellent financial track record. The FY22 revenue growth was the strongest ever at 46% year-on-year. And if you look at the 9 months of FY23, the revenues have grown 15%, while profits were up about 23%. Also, the margin profile of the company has been improving. The adjusted margins have grown from 16.5% in FY20 to 19.2% in 9 months of FY23. And now this will be the third listed IT company from the Tata Group stable after TCS and Tata Elxsi. But how do Tata Motors shareholders benefit from this? Monetization of stake in Tata Technologies is definitely a positive for Tata Motors. The Tata Tech IPO, along with the receipt of consideration of the electric vehicle deal with TPG, will help reduce debt of the company. Tata Motors, in fact, is now well on track to achieve zero debt on its India business versus about 12,000 crores of debt as on December 2022. Brokerages are quite bullish as well. Motilal Oswal has ascribed a value of 25 to 47 rupees per share in Tata Motors for its stake in Tata Technologies. Back to you.
All right, Sonia, thanks very much for that. And with that, it is a wrap on this edition of Halftime Report. Many thanks for watching. Don't go anywhere. Business Lunch takes all the action forward.